Well, good morning, John. It's good to see you. We're recording this on Wednesday morning. Um, Very quiet overseas at the moment. It's midsummer, and a lot of the fund managers are away on holiday, very low volumes on Wall Street, but they still seem to be eking out small gains. And I think this morning I read that have hit the 37th all-time high on the S&P 500. So just for the year to date, where the Australian market is only up 4% year to date, and the Dow Jones Industrials up about 4 or 5%, the S&P 500 is up 17% year to date, and the Nasdaq is up about 22% year to date. So very wide differentiation there. At the moment, Jay Powell is giving testimony to the Senate Banking Committee for the next 2 days, and we'll wait to see what the quarterly CPI numbers look like. But certainly the market is expecting a reasonable number, and that the likelihood of a September rate cut is increasingly coming into view. What are your thoughts there, John? Do you think that we'll just carry on in this slow rise up, or any other thoughts?
Well, I think that you can observe that very few stocks are pushing up the S&P 500 and the Nasdaq to its higher levels, and I was looking at a report which I'll publish in a few weeks. You know, the stock market value of Nasdaq and the S&P 500 is grown much faster than the earnings have. So price earnings ratios have expanded, and it's been in a limited number of stocks. So we just have to watch that in terms of value. In terms of the interest rates, I think it's becoming increasingly clear that we are getting closer to the first interest rate cut in America. I think Powell is saying that, and I think your reports, Paul, in your quick bites regarding employment growth in America is slowing at a nice rate. So it's not recessionary; it's just slowing, and gives more confidence to the central bank to cut interest rates. So everything's set, so to speak, but the anticipation of the market for those interest rate cuts is probably a little bit excessive in America, I'd suggest. I think interest rates are coming down in the second half of this year, which we're in now, but not at the rate that everyone expects in America. And certainly the election, Paul, will slow the interest rate decrease trajectory. The only final point I'd make, and there's increasing commentary coming out of America, apart from the Joe Biden issue, which everyone's aware of, is the fiscal deficit of America is around 7% of GDP, an extraordinary high number, which has to be brought under control. And as we've been saying for weeks, Paul, we've only had one debate so far between the presidential nominees. No discussion regarding getting that deficit under control, which says there will be constant pressure on the bond market to fund the American government. And we again have to watch that, because if bond yields increase because of weighted supply, then that'll certainly put a pressure on the equity market PEs.
Although I just see that FactSet is predicting, we're about to enter Q2 earnings season in the US. FactSet is forecasting, well, the consensus forecast is for earnings per share growth of around 8.5 or 8.8% year on year, which is pretty good. So maybe we can carry on. Before we leave it, I know that Joe Biden is busy meeting with NATO leaders in Washington, and I'm sure everyone's sitting on the edge of their seat seeing whether he can complete a full sentence or not. Do you have any thoughts about how the market might respond to a Trump 2.0 presidency?
Well, whatever we think, I think the if you look at the betting markets, and you look at the flow-on effect from that debate, I'd say the market is anticipating Trump being elected. So it won't be a surprise this time. I think that's something we can take out of it. Last time Trump was elected, it was a surprise, and markets took it well. This time it won't be a surprise if he's elected. As I said in the previous commentary, I mean, we have no discussion around the American deficit and how that's going to be brought down. Trump seems to be suggesting tax cuts, but increasing tariffs and tax paid by foreigners in America. Now, whether that is a net positive for the budget, I don't know, because obviously they're all thought bubbles at present. There's nothing backing up anything in terms of economic strategy coming from the two nominees. I just suggest that we're in a period where Trump gets in, no surprise. The biggest issue, as you just mentioned, is NATO. What's his policy towards NATO? It's obviously to reduce American investment in defence of North Europe. We know that's his policy. He said that 8 years ago. So Europe has to look after itself in defending itself against Russia. So I think the NATO discussion is really about celebrating 75 years, isn't it, Paul? Rather than anything strategic. I think it's just a birthday party, which is disappointing because the recent events in Ukraine have been highly disturbing about Russia. I guess if we just talk about that, that keeps pressure on grain markets, keeps pressure on energy markets. The Indian Prime Minister's visiting Russia, which is, again, a little bit disappointing, but they're playing to their own benefit there in terms of what India is doing in terms of supply of energy from Russia. It is disturbing what's going on, but I think the increased activity of Russia in Ukraine for a bombing suggests that they're trying to do as much damage before they go to a peace accord.
Yeah. Yeah, it is extraordinary that the presidential candidates spent more time talking about their relative golf swings than they did about
Russia, Ukraine, yeah.
Or Russia, yeah. Anyway, let's bring it back home. John, one thing I've noticed over the last month is the rise in the Australian dollar. It bottomed around 62 US cents. It's now 67.4. Are we going to see a stronger Australian dollar? What are the implications for the market? And is it just a reflection of the strength of the American dollar fading, or is there something else that's driving the Australian dollar up?
Yeah, look, I think it's totally about the American dollar fading a bit. It's being well overbought, but certainly supported by very high cash rates, as we've been talking endlessly for the last year. The 5.5% cash rate in America is way too high against their inflation, so they're very high real interest rates. Australia's currency has decoupled from commodity prices. It's a great debate, but the Australian dollar is very much determined by investment flows, which are excessive coming out of our superannuation industry, so flows out of the country. Saw an interview just yesterday by one of the major industry funds who's looking at piling into the UK property market, the commercial property market, which just says it all. Yes, it might be counter-cyclical, but Australian industry funds piling into international property markets because they've got too much money to invest. That's all that is symptomatic of. It might be counter-cyclical, that's the argument, but for the benefit of Australian beneficiaries of those funds, I doubt it. I think that's just nonsense. But that's what we're dealing with, Paul. And the more money that goes out of the country, the more Aussie dollars are sold, the more pressure on the Aussie dollar. So the Aussie dollar is battling. The little Aussie battler is battling up. It's going to be a steady increase, I predict, over the next 3 or 5 years. But the constant supply of Aussie dollars coming out of industry funds selling it is a big issue as we move up against a weakening US dollar. Now, whether, going back to the previous question, a Trump destabilises the US dollar, honestly, you can't make that prediction given the political upheaval going across Europe at present, in France and UK. I mean, which currency is safe based on the political analysis? I don't think we can come up with any. One final point is Japan's announced that they're having high-level meetings with the central bank and institutions and bond investors, that they're just trying to work out how they can slow down their quantitative easing program. Interesting chart I saw this morning, Paul. I sent it to you. You can probably put on quick bites that the central bank of Japan owns about 55% of all bonds on issue. Foreigners own about 3%. So it's a completely contrived market. They're now trying to work out, well, how can they get that ownership down? That'll be interesting. But as the Japan economy sort of comes out of 25 years of morass, I guess you call it, that's the opportunity for the central bank to start withdrawing slightly from the Japanese bond market and getting yields up there, which may see a recovery in the end. If you think about that could be a slow recovery in the end. So yen and Aussie dollar might be good places to be in the next 5 years.
It's interesting when one doesn't have confidence to invest in any particular currency. Usually gold does well as a hedge. Perhaps we'll leave that for another occasion.
Well, I'll make this point, Paul, just before you ask the next question. Yep. I was at a restaurant last night, and it was a pub, and I hope the guy's not watching this, but I was paying my bill, and the manager of the pub had his phone on and looked at me that he was trading the stock market. I said, "Oh, you're buying NASDAQ, eh?" It was about 6:30 at night. I said, No, I'm shorting one form of the Bitcoins. He mentioned some name I've never heard of. I said, "You're shorting it, so you're selling it?" "No, I'm shorting it." I said, "No, you're selling it. That's the same thing." He said, "Oh, you're shorting it because I don't own it." But this is a very small example of what's going on in society. There are people trading things which don't exist. So there's a lot of liquidity around, is my point, and a lot of speculation. And the answer to a lot of the yields of the world is taxing speculation, not taxing endurance. I keep on saying this, but no one listens. But there's a great opportunity for the governments of the world to raise tax by taxing the endless movement of money in speculative assets. But that's answering a question, Paul, you didn't answer. Anyway, your next question.
It's the point that you've made over the last so many years that that's a very fair point, I think. I wanted to ask, I noticed yesterday that Commonwealth Bank hit a new all-time high. I think it was 128.75 or something like that. It's the one sector that's actually done really well over the last little while. And yet, I wonder whether it's overdone. Do you have any thoughts about the Australian banks? They seem to have performed really, really well.
Well, if there is international investing in Australia, and I think if there's only a small increase in international fund managers' allocation to the Australian share market, it'll have a magnifying effect on very few stocks. And it's the leading stocks, the liquid stocks, who get the benefit. And if you're a foreigner looking at Australia and you want to buy the top 20 or 30 stocks, which is probably all they want to buy, given the amount of money, there's 65% of your choice is banks or resources companies. So today, you're probably more inclined after a strong rally in resource companies, and we've talked about the metal price increases in copper and now iron ore is coming back a bit. And I think, it's probably hit a level where it's going to stay at around that $100 level for the next year or so. So if you want to buy the Australian economy, you're probably dragged into the banks if you're an international investor. And I think Commonwealth Bank, as we know, is the largest bank, and it's a liquidity uplift, Paul, and it's very similar to what we're seeing in NASDAQ. Some of these larger companies are being pushed up because that's where the liquidity is available to buy and invest in a market. Does it mean anything? I don't think it means much at all. The issue for the banks, as we keep on saying, is so long as the Central Bank of Australia doesn't cause a mortgage issue by putting up interest rates, the banks are okay at present. Are they fully priced? Absolutely, they're fully priced. But they're levered entities. They do well when things are good, and they do particularly bad when things are bad. But we're not looking at bad things happening in Australia, so it's a fairly safe space to be at present.
Last question. Although we're not looking at things being bad in Australia. I did look at business confidence and consumer sentiment numbers that came out yesterday. Although both are weak, they're not too weak, I guess. Is the Australian economy slowing down? Are we at risk of a recession? Do you think that the next move in rates will be up or down, but this time in a year's time, or perhaps by the end of the year? Any change?
Interest rates shouldn't go up in Australia. Look,
no.
I mean, you get all these numbers, Paul, and they confirm the fact that the Australian consumer, the Australian householder, is under immense pressure. Yeah. And yet you get economists saying that if the budget supports the household sector through tax cuts and through energy price discounts, that's stimulating inflation. I mean, they can't both be right. The Australian economy is dragging its feet along the ground. We've had the reports, and it's well reported this morning and last night that Australia's real wages are the negative 4.8% since the COVID crisis. And we're one of the few Western countries where real wages are negative now. The rest of the world is generally caught up with inflation. We're not. Now, the focus on what I call gross wages against inflation is the wrong approach. We should be looking at the net wages after tax cuts. And I'm hopeful that the tax cuts, when we put that through, will bring real wages back to where they were pre-COVID. But the inflation surge we're seeing and the cost of living surges we're feeling, and certainly low-income households, it's going to take a while for those people to get their confidence back. And particularly, we don't have any direction from government. We have all this difficult information coming out of so-called economists telling us that we can't cut interest rates because it'll cause inflation. We can't stimulate the economy because it'll cause inflation. Yet the average person is struggling. So my point is, I think what you're seeing in terms of consumer sentiment is indicative of the issue of cost of living, and it has to be addressed by government. And it's increasingly obvious to me that the government doesn't have a strategy. It'll come out with a grab bag of things pre the next election, whenever it decides to call it, and a little bit of gossip about whether they call it early. But it's such a schmozzle at present, I don't think they would. So the consumer and the household sector just looks at the political landscape of Australia without any guidance about where we're going, and this confusing rhetoric from economists telling us that nothing can be done to stimulate the economy because it will cause inflation. Yeah, very confusing is the point there.
Well, we'll have to leave it there, John. We've run out of time. Interesting discussion as always. Thank you very much, and we'll wait on those US CPI numbers tomorrow, perhaps, and earnings over the next week, and see whether that provides a new direction for the market. Thank you very much, and see you next week.
Thanks.